Every year, millionaires and billionaires in America pay a smaller percentage of their income in taxes than many middle-class workers do. Public frustration often centers on images of offshore bank accounts or illegal evasion. However, the strategies used by the ultra-wealthy are documented in the law and published by the government. These methods are 100% legal, hiding in plain sight within the thousands of pages that make up the official volumes of the tax code. The system is structured to reward specific financial behaviors and increase the burden on others. Understanding how the wealthy shield their assets requires a direct look at the government's own blueprint. For most Americans, the financial reality is defined by a W-2 paycheck. This is ordinary income. This income is taxed at the highest tiers, with federal rates climbing as high as 37%. Compare that to the investor's reality. When assets like stocks or businesses are held for over a year, the profit is taxed as long-term capital gains, which caps at 20%. That 17-point spread represents a massive structural advantage. The system prioritizes the category of the money over the total amount earned. The challenge for the wealthy is accessing that wealth. Selling investments to get spending cash would immediately trigger the capital gains tax. To avoid this, investors use portfolios as collateral for bank loans, securing liquidity without selling a single share. Because loans must be repaid, this cash isn't categorized as income. The portfolio remains intact and grows in the background while they spend the borrowed money. This culminates in a final legal reset upon death, known as a stepped-up basis. When an individual passes away, the tax basis of their assets resets to the current market value. This eliminates decades of accumulated capital gains in an instant. Heirs inherit these assets and sell them immediately with little tax liability, allowing wealth to pass between generations without the standard burden a worker faces. Real estate offers a separate asset class with its own distinct set of legal protections. One primary tool is depreciation. This allows owners to deduct a portion of a property's value each year as a paper loss. Owners use this deduction to lower their tax bills, even while the actual market value of the property continues to rise. When it comes time to sell, investors use the 1031 exchange rule to avoid the tax bill entirely. By rolling the profits into a new property, investors defer capital gains taxes. This process can be repeated indefinitely. This creates a cycle of tax deferral that rewards those who hold and exchange property, rather than those who liquidate their holdings for cash. Business owners gain further advantages, deducting lifestyle costs like vehicles as legitimate operating expenses. In the stock market, investors use tax loss harvesting, selling losers to cancel taxes. High earners use backdoor IRAs to secure tax-free growth. These are separate daily tactics that share a single goal: recategorizing wealth to avoid the rates applied to ordinary income. None of these strategies are secret. They are the public operational rules of the government. Utilizing this blueprint requires significant initial capital to acquire the assets in the first place. Navigating these rules also requires professional guidance to ensure every deduction and exchange stays within the strict boundaries of IRS regulations. The most significant advantage is time. The wealthy can plan financial moves across decades, while the middle class are often forced to manage expenses from month to month. These tools remain available at smaller scales, however. Even without a massive portfolio, an individual can use the same underlying rules through basic tax loss harvesting in a retail brokerage or strategic retirement account contributions. The tax code rewards capital over labor. Gaining these legal advantages requires a shift in focus, moving from the pursuit of higher wages toward the gradual ownership of assets.